Okay, so the next step then for our incomplete records type B is step 2. So we're going to make any adjustments for any assets, expenses, gains, loans or interest. So we're going to look down through the question and see if there's any assets, investments, gains, loans, interest. So each week Fuller took from stock €80 and cash of 170 for household expenses. So that's going to be looking at our drawings when we come up to our drawings question or our drawings adjustment. He borrowed 120,000 and with 30,000 of their personal fund he used to purchase an adjoining premises. So we need to increase our premises by the value that we bought. So we also need to, this 30,000 then is going to be your capital. So we need to increase our capital by 30,000 because he's introduced it from his personal funds, so he's put capital into the business. It was agreed that a sum of money will be repaid in 20 equal half-yearly installments, so we need to calculate how much our installments are going to be, and then we need to calculate the rate of interest. So there's about 4 adjustments to go with this one. So if you look at our premises that we have at the moment, the value of them are 292,000. We got a loan of 120,000 and then we put in savings of 30,000. So our premises have increased to 442,000 and that goes into your financial assets in your balance sheet. Now the loan then, it says, is agreed that the sum borrowed will be repaid back in 20 equal half-yearly installments. And the first becomes due on the 1st to 2nd, 2009. So we got a loan of 120. So we're going to use the 120 divided by 20 to see how much one installment is. So that's 6,000. Then these are half yearly in the question. So if they're half yearly, that means we're making 2 every year. So that's going to be 12,000. So 12,000 goes into your balance sheet as a current liability. Our creditors due within 1 year. So remember, this first installment is going to be paid back on the 1st to 2nd, 2009. So it's due within 1 year. So that's why it goes into our current liabilities. And then we're going to reduce our principal by 12,000 because we would have had 12,000 paid. So our loan is left then is 108,000 and that goes into your balance sheet and your finance by section. So we've adjusted our premises with the 120 and the 30. We've accounted for our loan repayment, which is now 108,000 because we've paid 12,000 off it. That 12,000 is our installments multiplied by 2 because we're going to make them 2 installments a year. So that's going to be 12,000. And then the next one then is our loan interest. So it's telling us that 6% to be paid monthly at the end of each month. So remember, we got on the 1st to the 8th, 2008, and it's 120,000. So we're going to take 120,000 multiplied by 6%, multiplied by 5/12. So the yearly amount is going to be 3,000. So then we're going to have a look in the question to see, did we pay any loan interest like you would in type A? And is there any loan interest then for drawings? So we have a scan down to the question. So see, 20% of rates payable is for private use, and we paid interest of 2,000. So we're going to take the 3,000. Remember, that will go into your profit and loss account. Take away your 2,000, so you got 1,000 left. That goes into your balance sheet in your current liabilities. Drawings then, 3,000 of the yearly amount, 20%, 25% of that then goes to your drawings, which is 750. So the expense that goes into your profit and loss account is your 2,250. So you've adjusted this 3,000. And then the capital introduced then, we've got savings of 6,000. Using this question, it gives a grant. So you lodge a grant here of 6,000. Just have a look to see if you got any grants, any dividends will also be capital introduced and if you introduced it into the business. So that's going to increase your capital then to 36,000 and that goes into your finance by in your capital section. So that's your first part. You're looking at adjusting from your first paragraph here. 4 adjustments as part of it. You got your premises, your loan repayment, your loan interest, and your capital introduced.